There are three major tax brackets that every retiree needs to know about. The first are federal income tax brackets. The second is federal capital gains tax brackets. And third are your state-specific income tax brackets. In this video, we're going to be covering the federal income tax brackets in detail for 2025. So what we're looking at here are the 2025 federal income tax brackets. Now, these brackets become far more important when you retire than at any other point in your life. And the main reason for this is when you retire, you have more control over your income than you had at any other point in your life. Prior, when you were working, your employer just told you what your salary was, and that was your income for the year, and you paid taxes as you moved through these brackets, and there was very little choice. When you retire, a bulk of your income may come from Roth IRA accounts, taxable brokerage accounts, or pre-tax accounts. And so you may have this baseline Social Security that you're collecting, but then to supplement that, you need to choose which accounts you pull from and when do you pull the money. And so you have the ability to not only keep your income low by perhaps pulling from a Roth IRA, or you can actually shift when income occurs from one year to another. Now, pulling from a Roth IRA would be unusual, but there are instances where it can be quite valuable. For example, if you are right up against an IRMA surcharge bracket, which is a cliff and will increase your IRMA surcharges substantially, and you need some money, drawing from a Roth IRA will not increase your income and could actually keep you from paying the IRMA surcharges. So that's an instance where that particular draw keeps your income lower and is quite valuable. So knowing where these brackets are and the IRMA surcharge brackets and net investment income is quite valuable. Let's talk about these brackets and how they work and how to navigate them. So first, we'll talk about how you pay taxes here in the U.S. If you have a taxable income of $1,000, and this is after your deductions, so this is line 15 of a Form 1040. Let's say hypothetically you had $1,000 of taxable income. Your income would be above zero, but below the top of the 10% bracket, which is $11,925. And so you would pay 10% on your $1,000 because you fall in that bracket. 10% of $1,000 is $100. When you have this $100 in tax, being in this 10% bracket, this 10% bracket is known as your marginal tax rate. That's the bracket that is the highest bracket that you fall in. This is the bracket that financial advisors and your accountant, etc., are usually most interested in, because any activities you do in terms of recognizing income, you'll pay at the marginal rate. So your marginal rate is super, super important. I'm going to go ahead and increase this number up to $65,000. So let's say you have a taxable income as a single filer of $65,000 in a given tax year. You can see this is higher than the top of the 10% bracket. It is higher than the top of the 12% bracket, but it's lower than the top of the 22% bracket. And so you actually fall in the 22% bracket, between 48 and 103 for your income. This means your marginal rate is 22% because that's the bracket that you reside in. Your effective rate, however, is less than your marginal rate. Your effective rate is the total amount of taxes you pay divided by your taxable income. That will always be lower than your marginal rate. And the reason is on this $65,000, you actually, the first $11,925, you only paid 10% tax on. Then you moved into the next bracket. On the next roughly $36,000 from $11,925 to $48,475, you paid 12% tax on that. Then you moved into 22. And it wasn't, except for this last roughly $17,000 from the $48,475 to $65, that last incremental amount you paid 22% on. So your marginal rate is 22, but your effective rate was only 14.2% roughly. So that's how the tax brackets work. And the reason that these are so important, again, is because you have far more income control in retirement than you ever had previously. I'll give an example of this. Most people, when they retire, they may have lower income immediately following their retirement than before they hit RMD age, or the required minimum distributions. Those RMDs tend to push people up into higher tax brackets. Let's say hypothetically, we'll move here to someone who's married filing jointly that has $210,000 in income. You can see here their marginal rate is 24%. They fall in this 24% bracket. And when you're doing a calculation, such as a Roth conversion, you may forecast out your income and say, we're in the 24% bracket for a long time, right? Because we're at 210, and as I forecast our RMDs growing and I forecast out our income growth throughout retirement, we're not going to get above this 394 for a long, long time. So we don't really need to do Roth conversions. Being aware of where you're at in that marginal tax bracket is a good thing. That analysis is a good thing, and it's close to correct. The problem with this is you want to be aware of not only the married filing jointly tax bracket, but also the single tax bracket. We talk very often with individuals, and we mention, hey, you are in the 24% bracket for a long time, but we would recommend doing a Roth IRA conversion anyways. And one of the things that we reference is tax bracket compression. And what we mean by that is, if you were to survive your spouse, meaning your spouse predeceases you, you'll end up a single filer, but your RMDs will very likely stay the same size. And so when that occurs, we can take a look at this household as an example. If they had $210,000 in income previously, and one of the spouses were to pass away, you can see if they have the same amount of income and end up filing as a single filer, the marginal rate is now 32%, because that same $210,000 in income is in a higher bracket as a single filer. The single filer brackets are about half the width of the married filing jointly. And so understanding how these brackets work and how you have the ability to control when and how you recognize your income to minimize your overall taxes is super valuable, and it plays into almost every planning opportunity from a tax strategy perspective, is understanding these and navigating these efficiently.